What's up, guys? Julian here from jlewistrading.com. We're just going to do a quick little overview of one of the trades that I put on today on the S&P chart here. And you can see that there was sort of this flat movement throughout this area of consolidation into the pre-market. And what we were doing, I was just simply monitoring the high and the low. It was a very, very simple range-based trade that I was doing, and the idea was simple: is that I'm going to take the break out or the break down, whichever side of this range gets taken out. That's the direction that I'm going to trade. I was more or less biased to the long side simply because the prevailing trend as of short was long. So generally speaking, when you see these uptrends and then this long area of consolidation. Consolidation is more a representation of just sort of a break, not necessarily a reversal. It can be a reversal. If this thing broke down, it would have been definitely a reversal area of consolidation. But in this particular trade, on this particular chart, you can see that we were bullish, had that leg up. We trended sideways, but then you can see just sort of around pre-breakout that price action started to work its way to range high resistance area, and it eventually just broke out, and it actually moved very, very strong out of the gate for quite some time. This is a 15-minute chart, so you can see that this thing actually moved up for most of the day to the upside, and we were in this trade right down through here at breakout. And my risk on this was very, very simple. I was trading the breakout, and my risk was essentially right here at the low of the range. So if the range snapped, if this breakout would have snapped down and came out and down, crossed through the entire range, I would have gotten stopped out. If I would have gotten caught into a bull trap or a really deep whipsaw, almost like this two candles right here, that range low would have caught me and stopped me out. But what ended up happening is I saw about 3.5 times my upside as I did downside, which was nice. It's a pretty decent trade, and that's essentially what we were doing. So, when you see these areas of consolidation, what you want to do is you want to look at what was the preamble to that area of consolidation, and you just sort of want to, generally speaking, become a little bit more biased to which direction this range is going to break out based on its previous move. Of course, what you want to do is you want to cross-reference that with your momentum indicators and trade in the prevailing direction of both price action and momentum. So those are two things that I look at. So this was a very, very simple trade that we put on. Again, it was consolidation. The S&P 500 today in the American markets opened flat. And this is that flat area that they were talking about. You can see it had and ran a pretty tight range for quite some time. Did jock a little bit through here. But again, looking at what the prevailing trend was prior to that area of consolidation is exactly what we were looking at. And we were looking to use that previous information as some insight as to where this could potentially go. And again, we took out resistance. We did so with our momentum indicators all suggesting that momentum was moving to the upside. And so when you take all of those things and compound them together, you really, really sort of you build out a model where the probabilities are in your favor, and that is sort of the direction that you want to trade and the mindset that you want to have when you're looking at potential trades. Because this is a trade done on the 15-minute chart, I obviously had a little bit more time to think about this trade and wait. Because usually I'm trading a 1-minute chart on the U.S. stocks, and I'm trading that first hour and a half to 2 hours of the market, and I'm doing so on a 1-minute chart. So you have to be very, very nimble when you're trading that way. With this particular trade, again, because it's on a 15-minute chart, every single one of these candles represents a 15-minute block of time. So I had more time to sort of figure out what this trade was going to be. But again, super easy. Prevailing trend yesterday was bullish, long area of consolidation, and then we broke to the upside. And actually this candle right through here, you can see that we had almost like a tweezer top. What looked like preamble to a breakdown was taken out by this candle. This is where the president was speaking today, and there was some bullish news on tax reform, tax policy, yada, yada, yada. So there was a bit of a push after that, and I guess the market started to sell off a little bit, and that little bit of sell off is probably people that were long here and now taking profits. That's what I'm assuming. That's where I was. I was out roughly up through this area right through here. As soon as this candle crossed down, my risk kicked in, and I was stopped out of this trade. So again, stop was initially down through here at the bottom of the range. And what I do is with every closing candle, I actually move my stop up to that previous low. And so when we got to this candle, you can see that we had this inside candle and it decided to roll over slightly and it triggered a sell for me, and I left in profit. So again, 3.5 times the upside as I did risk. Not a bad trade. S&P 500 trade, super simple, 15 minutes. It doesn't take a brainiac to understand how to maneuver in and out of this style position. Anyways, if you have any questions, feel free to email me at info@jlewistrading.com. If you want to check out some more free videos, we do have a free video library that is on our website at www.jlewistrading.com. See you in the next video lesson.